Hello trader, welcome to part 2 of our series on stock or portfolio insurance presented by PowerOptions. In part 2 of our series we're going to discuss selecting the right put on a broad-based ETF or index to insure a portfolio. For those of you who don't know me, my name is Michael Chupka. I am the Director of Education here at PowerOptions, and I hope you get some useful information out of this part of our presentation. Before we begin, we just want to recap part 1 that was posted in the blog at PowerOptions. We looked at a broad example of having 80% of a portfolio invested in straight shares of SPY, the S&P 500 ETF, and 20% of that value remaining in cash. We were looking essentially at a $1 million portfolio with $800,000 invested into shares of SPY. Now we evaluated the common ways a stock or options investor might look to protect 80% of that investment against a 10% downturn in the market. In other words, if we saw a 10% decrease and we wanted to hedge that to only a 5% loss, what actions could we take to protect our investment? The common approach is, of course, simply to set a 5% stop on your position or a trailing stop. Now that is very useful if and only if the decline happens during market hours. If it's an overnight gap of 10% or 15% down in price, the stop or the trailing stop gets violated, you don't get filled for the 5% loss, you get filled at much less. Number 2, we could sell out now and stay in cash. Avoid the downturn, maybe play some bearish positions. It's also advisable. But if you wanted to maybe stay in the position, control the losses, well, we also showed how you could buy shares of an inverse ETF, such as SH, the inverse S&P 500, but the cost wasn't really that effective. It's too much money to protect the portfolio. We could use leverage. We could have bought shares of the 2 times bear or 3 times bear inverse ETF against SPY, but again, proved that it wasn't as cost effective. So if we wanted to stay in the position, hedge our potential loss without closing out now, we looked at buying puts to insure the position directly. And of course, number 6 was buy a put and sell a call against it to generate some premium to create a collar position. What was the best choice on that basic example? Well, again, to stay in the position with control. Limit the risk to your desired range. The most economical choices were number 5 and number 6. Now, in the blog, we discussed having a position in a $1 million account where we would have bought 3,200 shares of the SPY ETF at $250 per share. It'd be around $800,000 investment. To hedge that position, if the stock fell 10%, well, we know we'd be looking at an $80,000 loss on our investment. We wanted to control that to only lose $40,000 or a 5% loss. That's why we analyzed buying the 18 put contracts. Now, in the blog article, we discussed the first clarifying point. Your question is, how can I protect my portfolio against a X% decline? 5%, 10%, 15%. The clarifying point that was needed was how much of that X% decline did you want to protect? So if we wanted to hedge 50% of the decline, we chose an option, the at-the-money 250 strike for SPY that had a delta of 0.50. Now what does that mean? It means that for every dollar the stock drops, our put with a delta of 0.5 should gain 50 cents. But delta is ever changing. So if SPY dropped from 250 down to 249, we might gain 50 cents on our put option to hedge half of the loss. But now the delta is going to change. It might move up to 0.53. So if SPY drops another dollar down to 248, we might gain 53 cents on the put. And then the delta would go up again to maybe 0.57, 0.59. Well, thus begs the question, wouldn't any put strike work to hedge the 10% drop that we're expecting? Well, options do give us options. There are many strikes and many expiration dates to choose from. How do we know which one is best? Would a lower strike, further out of the money, lower cost put be better? Pay less, still insure the portfolio, makes sense. But to protect more, would a higher strike, in the money, higher cost put protect more? Well, the answer is yes and no to both. To find out which put we should buy, we need to ask ourselves, how much do we want to protect? In our example, we wanted an instrument that would gain $40,000 if the underlying fell 10% and cut the potential loss in half. If SPY dropped to 225 on or around mid-October, October 13th or so, we would likely look at the 20th of October expiration. The 13th could work, and now there's all sorts of Monday and Wednesday expirations on the 18th of October as well. But let's just keep it simple with a Friday series. If mid-October SPY did drop to 225, with only a few days remaining to expiration, our puts would go near to intrinsic value. Okay? Time value would decay out, we'd be near intrinsic. Our equation for how many contracts to buy is pretty simple. We needed a value of $40,000 to hedge a potential $80,000 loss. Assuming just intrinsic value, the equation becomes the put strike we're interested in minus the value of SPY at 225. That would give us the intrinsic value of the put. Now we did have to pay for the put, so the gain on that hedge would be equal to the intrinsic value, if the stock did decline to where we expected to, minus the cost of the insurance, be your gain on the hedge. Now we need $40,000, so we take $40,000 divided by that gain on the hedge, and that gives us the number of contracts. Remember, each put contract represents 100 shares of SPY. So when we looked at the October 250 put, if SPY is trading at 225 in mid-October, our 250 strike minus a 225 value would be an intrinsic value of $25 per contract. The gain on the hedge would be our value of $25 minus our cost for insurance, $1.95, which would be a gain on our hedge of $23.05 per contract. Well, represents 100 shares, so we'd have a $2,305 gain if we just purchased one contract. So how many contracts do we need? We need to hedge $40,000. Each contract would give us a $2,305 gain, which comes out to 17.3 contracts. Well, since we can't buy a third of a contract or half of a contract, we're just going to round up to 18 contracts. At a cost of $1.95 per contract, we'd pay out $3,510 to insure our portfolio. Here's the profit and loss of our hedge against SPY. We paid $35.10, so our total investment $803,510. Now the max risk is shown at $353,510, or 44% of our investment. That's true in the case that SPY dropped to zero. But if we see here, as the stock drops to 225, over on the left-hand side, we'd only have a loss of 38,618. We have 3,200 shares. We bought 18 contracts, which represent 1,800 shares. So if it falls further, we're still going to lose more. But if it hits our target, we can see here we're only at a loss of about $38,000. But aren't there cheaper puts available? We're looking at an at-the-money option, which does have the highest time value, not the highest cost, but the highest time value of all the options in the chain. Further out of the money puts, those below the current stock price, are going to have a much lower premium. Well, does lower cost mean better insurance? The October 20th 225 strike puts are only trading at 16 cents per contract instead of $1.95. But if SPY is trading at $225, those puts would expire worthless and we would get nothing back. But there are others that will retain intrinsic value if our target price for the decline is hit. Here's a simple chart showing us the put strike prices, the bid and ask, and a calculated midpoint for the 20th of October expiration. And we already talked about the 225 strike. The 230 strike has a midpoint price of only 23 cents compared to the $1.95 for our 250 strike. The 235 at 33 cents, 240 at 54, and so on. As we go in the money above the current price of 250, we start to see higher prices and larger midpoint spreads. Take a look at the 260. It has a bid of 816 and an ask of 1166. Well, the midpoint would be 991. But if SPY is trading at a 250, that put has to be at least $10. It has to be at least intrinsic value. You're going to pay closer to $10.50, maybe $11, even though the midpoint has it at $9.91. We're not going to be able to pay below intrinsic value. I also included the delta in this view. A lot of us assume that a higher delta, for example at the 270 or the 275 strike down here at the bottom with a delta of 1, if SPY drops $1, we'll gain $1 on the 275 put, a 1-to-1 ratio. Wasn't that a better hedge? Well, look at the cost. We'd be paying about $23 per contract. We would have a 1 delta. But how would that help the hedge? Well, of course, I'm going to break that down for you too. Let's take a look here. And we see now, up at the top is our original position. Purchased 3,200 shares, of SPY at $250 per share. Investment of $800,000. If there was a 10% decline in SPY, we'd have a value of $720,000 or a loss of $80,000. We looked at the 20 October 250 strike, purchasing 18 contracts based on our equation. $1.95 per contract, so our investment for the insurance would be $3,510. If SPY hits 225 on or around mid-October, the value of our hedge would be $45,000. So we'd have a gain of $41,490. Now, down below we see the other put strike prices available. The price per contract, the investment amount, the value of those puts if our stock was trading at the 10% decline, and of course the total gain on the hedge taking out the investment amount. We already talked about how the 225 would not work. If our target price is hit, there's no value remaining, so we didn't get any gain on our hedge. Now the 230 strike and the 235 are interesting scenarios. Using our equation we just showed, to get a $40,000 gain on the hedge with a 10% decline, I'd actually buy 84 contracts of the 230 put. Well, my investment amount would be $1932. The value, if the stock was trading at 225, would be $42,500, so we'd have a gain on the hedge of $40,488. Now, what does that mean? It means I bought 84 contracts of the lower priced option, but I only have 3,200 shares to protect. So I'm essentially insuring 8,400 contracts, the price of only $1,932. That probably looks like a better scenario on paper. Of course, the 235 strike, 42 contracts would need to be purchased. So we've got an extra 10 contracts, puts representing an extra 1,000 shares above our 3,200 block of SPY. This investment's only $1,386, with the 235 having a 33-cent price per contract. And the hedge would be a gain of about $40,614. Now, once we get to the 240 strike, we're back to a lower ratio, where we're not paying the 1-to-1 32 contracts to represent 3,200 shares. And we're not going over that ratio either. And when we get into the in-the-money options, our 255, the 260, the 265, those are trading right around intrinsic value. We only need to buy 16 contracts, or half of our current block of shares. But look at the price. The 260 strike, price at about 10.02, a little bit above intrinsic value. The investment is $16,032. But if SPY drops to 225, the value of our 16 contracts would be $56,000. So we're pretty much still hedging against that $40,000. Now let's take a look at our ratio contracts, the 230 and the 235 strike, which give us a benefit, but not necessarily the risk we want to hedge. Let me explain why. These combinations are interesting. Many of the combinations we saw were less than 1-to-1. We're buying less contracts than the 3,200 shares that we own. Our example 250 put was only 18 contracts against 3,200 shares, which technically left 1,400 shares unprotected. That's why the loss on the profit and loss chart we saw went to 44% if SPY continued down below our target price. And that 44% loss only occurred if SPY was at $0 value. We'd have much bigger problems in our account and probably in the world if SPY went to 0. But we want to protect our money. So the 230 and the 235 puts give us that higher ratio and an interesting profit and loss chart. 84 contracts of the 230 put were what we showed we needed to invest in to hedge our loss by half, $80,000 loss to $40,000 loss, if SPY hit 225. Because we have more put contracts than we have shares, if SPY drops further than our target, we hedge the loss on the 3,200 shares and we start to gain on the 52 remaining contracts of the put. Now that's unique. It gives us sort of a synthetic straddle position with owning shares of stock. We see on the chart if the SPY fell down to 180, we might have a gain of about $186,000. But if the decline isn't as big as we thought, if SPY only drops to 230 instead of 225, the loss at the peak would be $65,932. The $40,000 gain on the hedge is only effective if the stock is at our target of 225 or below. If it only falls a little bit, we're risking more than we wanted to risk because of the extra cost of those 84 contracts. Still a small amount, but the insurance hasn't kicked in. The insurance for the 230 put won't start to kick in until the stock is below 230. So if we're wrong on our target, even if SPY declines 8% and is right around 231 or 230 or so, we lose more than we wanted to. It would still be a loss of 65,000. We want to keep the loss to only 40,000. What about that 235 put? Well, similar concerns. We have a synthetic straddle in a sense, but the lower break-even doesn't kick in unless SPY is below 185. Although we'd have less of a loss, and we'd cover the loss if it was right at 225 to that $40,000 hedge. But if it only drops to 235, we're at a loss of close to $50,000, not the $40,000 we wanted to target. The question is, well, if it doesn't work to go into a ratio, if you end up buying too much on the position where that synthetic straddle looks kind of nice, but at the same time, if I'm not right, it doesn't fall as far as I expected, I'd lose more than I wanted to hedge. What if we just did a 1-to-1 instead of a 2-to-1? Well, that didn't come out in the equation either. We had 3,200 shares of SPY at 250 with our cost basis of 800,000. Buying 32 contracts of the 235 put for 33 cents would only cost about $1,000, $1,056. But remember, the insurance does not kick in until the stock drops down to 235. So we'd still take that loss, about $15, $16 really when we factor in the cost. But if it fell to 225, we'd only lose 6.1%, $49,056. But remember, that's not our goal. Okay, so let's take a look at that chart one more time. The 18 contracts of the 250 put would be worth $45,000 if our target price was hit, and with the cost, we'd have a gain of $41,490, taking the loss in the position down to $39,000. Notice the highest range of the gain on the hedge is right in that 235 to 240 section. 40,614, 40,488. Still not above the 250 at the money strike we selected. But there's a good range there where it's higher than the other gain on the hedges we're seeing for the other strikes. So maybe we want to target something in that range. Well, how would you know that's the range? Well, that's one of the tools we offer at PowerOptions. One of our signature tools is called the Long Option Finder. Now, this tool allows you to put in your projected price of a stock, ETF, or index, your target date for that expected price, and the investment amount. Once you plug in those numbers, this tool shows you the option that would give you the best bang for the buck. So we take that tool, we put in our values, SPY at 225, mid-October. We want to invest about maybe $4,000 or 0.5% of the value of our investment, $800,000. All right, and here's what we see. We've put in our four basic inputs: SPY, 225, $4,000 investment for the leveraged hedge, and a target date of maybe October 18th. And what we see here is exactly in the target range I mentioned, somewhere between 235 and 240. But the put option that would theoretically have the best bang for the buck is listed at top. The 20 October 236 put, that implied volatility of about 15%, current option volume 338 contracts. We see the open interest. The midpoint, 38 cents. If I did invest $4,000, I could afford to buy 103 contracts. My total position cost would be about $4,000, $3,966, including an estimated commission of around $100 for the 103 contracts. If SPY hits 225 on October 18th, the theoretical value of our 236 put would be right around $11. Well, that makes sense. It's right at intrinsic value, isn't it? ETFs at 225, we hold the 236 put, $11 of intrinsic value. So our hedge would be worth $113,000, or a percentage return of $2,752. This isn't what we would do, but it gives us perhaps a gauge of what strike we might want to target. We see a 236 strike, a 237. There's our 235 in third place. We want to look at it that way. 237.5, all within that range, about the 235 to 240 we saw on the chart. When we looked at our first little green graph there, why did I leave out the single strikes? Well, really for the sake of time. SPY offers 50-cent strike differences now that October 20th is considered a weekly series less than 6 weeks out. So we've got the 237.5, the 238, the 238.5, and so forth. That grid would have been overwhelming had I put everything in. We're using this as sort of a comparison to see the path that you might take to ensure your portfolio based on your expectations. Using that long option finder gives me an idea that there might be a better structured put out there to help hedge the position. We did narrow down the target range. The long option finder gives us the 236 put at 38 cents per contract. But we don't want to necessarily put in that full 103 contract value if we invested $4,000. We want to hedge our portfolio to our limited range that we decided upon. So how many contracts would we need to buy? Again, we run the equation. Our 236 put strike minus the 225 value of SPY, $11 of intrinsic. Take that minus the cost of insurance, 38 cents, we'd have a gain per contract of $10.62. But since each contract represents 100 shares, that means we'd be paying $38 per contract and we'd have a gain of $1,062 if our target was hit and SPY fell to 225. We need $40,000 hedge, because if SPY declined 10%, we'd have an $80,000 loss on our holdings. So this comes out to 37.6 contracts, and again, we're going to round up to 38. So what is that going to look like? We see here, where are we? We've got that slight ratio again. We have 3,200 shares. We're buying 38 contracts. If SPY is at 225, we would have a loss of only 39,644. But if we're wrong, and it only falls to 236 or 235, we're at a loss again of 46,244. And of course, if the decline is more, because we've got that ratio structured, we'll start losing less. Those extra 8 put contracts, so we have 38 contracts to 3,200 shares, would start gaining more. And of course, we see less of a loss and less of a loss. And on the chart, we can see the lower break even is right around 161. And that's a huge decline we're not expecting. And if the stock did fall to 225, we would have hedged our loss effectively to only 39,644. But there's still that chance that if it doesn't fall as much as we expect, we're risking 5.8%, $46,244, about $6,250 more than we wanted to lose with the insurance. So what is the solution? First, you have to decide what effect your expected decline would have on your portfolio. Calculate how much of that decline you want to hedge. The long option finder is a good step to see which hedge would give you the best return if the targets were hit, but then you have to run the equation on that option to see the number of contracts you'd need to hedge your desired decline. But as we showed already, which is really important, make sure you graph the position. All of the scenarios we showed, or potential positions we showed, would hedge the portfolio to only a $40,000 loss in the case of a 10% decline, or an $80,000 loss in your investment. But some of those combinations that are above a 1-to-1 ratio might have a higher risk in that one scenario if the stock's trading right at the put strike price. It might not match your goals and your risk tolerance. Of course, the one we looked at, the 250 put, is less than a 1-to-1 ratio. And if the stock falls further than our expected decline, we could see larger losses. The pinpoint was right at 225. Now, there are ways, of course, to lower the risk further, to pay for the insurance and lower the cost of protection. Since you are expecting a decline, you could sell an at or out of the money call on SPY to pay for the insurance. But remember the pros and cons from part 1 in our blog series. Creating a collar, selling a call against the protected position, is going to generate premium to lower the cost of insurance. It's going to definitely lower the overall risk if your target price is hit, and it's going to bring your total cost basis down as well. However, it's also going to cap the potential gains if our timing's off and the underlying security or SPY moves up. Let's review. Here was the standard collar example we looked at from our blog, a standard 1-to-1 collar. What do I mean by that? We own 3,200 shares of SPY at $250, an investment amount of $800,000. Rather than buying the 18 contracts of the 250 put at $195, let's do a 1-to-1 ratio, and we'll buy 32 contracts, which would be a total cost basis of $6,240. Then we sell 32 contracts, which is covered by the stock ownership, simply a covered call with a protective put, or what we call a standard collar, for $1.10. So we collect in $3,520. Now remember, just buying 18 puts of the 250 strike for $1.95 would have cost us about $3,000 or so. By hedging it, we only add an additional $2,720. So now our risk on the position is only $2,720, or 0.3% of our investment. That's a huge benefit if there's a 10% decline. However, if we're wrong, and over the next few weeks SPY goes up to 252, 253, or 254, if we don't take action, we could be assigned on our shares and only make 0.5%. You are expecting a decline, so this is a good way to go. But we have to point out the structure, because if the opposite happens, you may need to manage the calls that you sell so you don't get assigned. What about using the other put we just looked at, the 236 put with 38 contracts, and then selling calls against it to create a collar? Now it becomes slightly different. Again, we purchased those 38 contracts of the 236 put. Would cost us $1,444. Now I can still sell 32 contracts of that 252 strike call to give us a little bit of upside for $1.10. So I'm collecting $3,520 back in. I only paid $1,444 for the insurance, so we get a nice credit above $2,000. Thus, our total cost into the position drops to $797,000. The max risk on this one would occur at the same spot. So we bought 38 contracts of the position, more than 3,200 shares that we owned. Why didn't I sell 38 contracts? Well, because I can't. Because if I did, 32 contracts would be covered by the 3,200 shares that I own. 6 contracts would be hanging out there as a naked call, which would require more margin. Not a lot. 6 contracts would require more margin. So we only can sell as many contracts of the shares that we own. Now this creates a collar, but it's sort of a hybrid collar. We get more premium than what we paid. We lower the cost basis. The max risk, right around the target, but it's still a little bit above, isn't it? It's $42,724. $2,700 above what we wanted to risk. It's only 5.4%. Now what's interesting here is it shows a maximum profit of $98,876. Well, that's true. If SPY continued down in price and dropped to $0 per share, our 38 contracts would have that high gain. We covered the 32 contracts. We'd essentially have 6 contracts that are worth $236 per contract. That's not going to happen. The max profit on the upside, if SPY goes above 252, doesn't decline based on our expectations, is going to be around $9,000, or roughly a little bit over 1% or so. Again, we would have to manage that short call as we would a covered call if it went against it. But we paid for the insurance, we lowered the cost basis, but again, the maximum risk, if it doesn't fall as far as we want, if it stays around 235, 236, is around $42,000. So we'd only lose 5.4%, but again, it's not our target. But this does give a credit to pay for the insurance. The risk in that one scenario, stock around 236, 237, 235, is a little bit higher than what we wanted to hedge. The gain, well, looks astronomical, but again, that's to the downside because we've sort of got this ratio in play. The upside gain is capped at around 1% or so. What have we accomplished? What we've shown so far is how different put combinations on a broad-based market ETF might hedge a position or a portfolio at a specific target price. Some of the hedges will have a higher than 1-to-1 ratio, which gives you the benefit to maybe profit in both directions if the decline exceeds your expectations. But it might have that higher risk if it falls only right to the put strike price. Most of the scenarios we saw on the grid were below a 1-to-1 ratio. We would still only have the loss that we were targeting of $40,000 if it did hit our target price of $225. But if it falls further, we have a larger risk as well. We wanted to run through these basic scenarios to give you an idea, to help you kind of see which options might give you the best hedge, whether you're looking at just a single stock and worried about a decline. or if we are protecting a whole broad-based market ETF, or a group of stocks in our portfolio that are mostly contained in a broad-based ETF. We could use QQQ or the NASDAQ if we were more heavy in tech stocks in our portfolio. But the other thing this example assumed to just give us a basic bird's eye view of the different structures we could use and what are the pros and cons of using a higher than 1-to-1 ratio or a lower than 1-to-1 ratio, it assumes that the position is right at our purchase price. Maybe we bought SPY 2 weeks ago at 249 and it's hovering right around 250, but now we're worried about a decline because we feel the market's weak. What if there was already a gain in your portfolio or in the SPY holding? What if we had purchased SPY $237.50, halfway between the current price and our target for the decline? Well, we're going to find it much easier to find the best protection, lock in much of the unrealized gain, and leave the upside open. Call this locking in the gains. So let's say we had that $1 million portfolio. We took $800,000 of it, invested into SPY at a price of $237.50, roughly be about 3,368 shares. This was the price around April 24th, 2017. Well, let's just keep the math simple. Let's round it up and say on April 24th, we bought 3,400 shares of SPY, $237.50 per share, so our total investment was $807,500. We have an unrealized gain of $12.50 per share, or 5.2% on our investment. But we're still worried about a decline from $250 down to $225. Can we lock in the gains? Absolutely. Another one of our signature tools that we offer is called the insurance tool. Just as we saw before with the long option finder, it's a real simple input. We're going to put in our stock symbol, our cost per share, our target month of expiration for where we're expecting the decline, and we can also structure it to look at a call to sell against it. So let's just put in our cost basis and our targets. We have SPY. Our cost basis is $237.50 per share, and we know that we're expecting a decline somewhere in mid-October. So we're going to select the standard October expiration for the buy put month. Right away, the tool will show us that here's the current price of the stock. We've got a gain of roughly around 5.2%, an unrealized gain on the position. Right at the top of the list, we see the 3 puts that we were originally considering, or within the range, because again we're dealing with that 50-cent strike difference. But what is this showing us? It's showing us that we could purchase the 251 put for a price of $255. This would make our total cost basis on the position $240.05. Our $237.50 cost basis plus the $255. But we're guaranteed to get $251 back per share if we purchase this put. So we've got a locked-in profit of $10.95 or 4.6%. Means whatever happens next, the worst case scenario is we'll still make 4.6% on the position. And we see the other breakdown here. The 250, of course, is at a 4.4% locked-in gain, and the 250.5 is at a 4.5. Okay, but what would it mean for our position? Owning those 3,400 shares now at $237.50, if we protected it 1-to-1 and bought 34 contracts of this 251 put, well, it was $2.66 per contract. If we bought 34 puts, we'd have a total investment for our hedge of $9,044. Down below, we see the profit and loss chart. What's the first thing that sticks out? There's no red. There's no loss on this position, even if SPY dropped to 180 or 165 or even 225 per share. We're guaranteed a 4.6% profit, and the upside is still unlimited in this scenario. What are the cons? Well, most of the insurance we looked at so far, the 250 put to hedge for our loss of only $40,000 was $3,510. We also looked at the 236 put, which would have only cost us $1,400 or so. So this is 3 to 8 times more than the cost of the other insurance that we looked at to hedge the 50% loss. But again, you get what you pay for. Here I could insure the entire position and guarantee that I'm still going to make 4.6% on the position no matter what happens next. Of course, in this scenario is where you might want to evaluate, maybe I just do sell out, take my gain of 5.2% if I'm expecting a decline, and stay in cash. But this allows you to stay in the position for fairly low cost. It's less than 1% of your total portfolio value. The $1 million portfolio, we're at less than 1% with an investment on the hedge of $9,044 to guarantee a worst-case scenario of a 4.5, 4.6% gain. And if we're wrong, and SPY continued up to 252, 253, or 254, we're still in the position and could still make a profit. But we could take this another way. Of course, we saw that the 251 puts there would lock in the most insurance, but again, if you only wanted to hedge half of that 10% or $80,000 loss to 225, remember our cost basis. If SPY fell to 225, the 10% decline, we would only have a loss of $1,250 or $42,500 on our 3,400 shares. We want to hedge that to half, $21,250. How many contracts would you need to buy? Again, run the equation. The put strike price minus the expected value at 225, our 251 puts would be worth $26. Our intrinsic value of $26 minus the cost of $266, again, gain per contract of $23.34, or $2,334 gain per contract. How many contracts would I need to buy? What is the value I want to hedge? It's $21,250. Divided by the gain on the hedge would be about 9 contracts. Let's round it up to 10. So here we are. Buy 10 October 251 puts at 266. What's the cost of insurance of $2,660? We hedge the loss if SPY is at 225 to our 50% loss of only 21,000 or so. But again, it's a worse ratio. It's less than half. We're only buying 10 contracts versus 3,400 shares, so we're at about a 1/3 ratio. We'll take a much higher loss if the stock continues down below our expected decline target. We also pay less, $2,600 instead of $9,000 to cover the full 3,400 shares. Why are we illustrating this? Because it's important to note that you get what you pay for. I could insure the whole position for $9,000 and guarantee a profit of 4.6% in the worst case scenario. Or if I only wanted to try to hedge half, pay less than 1/3 of the full coverage, but you get what you pay for. We can pay less per contract by going to lower strikes. We can buy more contracts than the shares we need to cover by going to some of those lower strikes. But you get what you pay for. Lower cost for insurance is not the best answer. What is the answer? In reality, that's up to you. Each investor is different. Each investor is going to want to have a different value of what they want to protect, and of course, each investor might have a different target for what their expected decline is if there is a market correction. We want to give you a path to show how to evaluate portfolio insurance with ETF puts. We saw how we could pay less and buy more contracts, but that might actually have a higher risk in that one case scenario if the stock's trading right at the put strike price. Of course, we could have a higher profit if the stock continued further down. Of course, we're showing one example to keep it simple. We looked at just owning SPY and we're protecting it directly with puts on the SPY. Well, if your portfolio was 10, 20, or 30 stocks, or even other positions, P500 stocks, you could take the same approach. If your portfolio is more allocated towards those in the NASDAQ. Securities in the NASDAQ, for example, you might want to look at QQQ, but you'd run the same equations and the same analysis. Or it might be in the Russell 2000 or so forth. And do remember, all of this is scalable. Okay, if you had a $100,000 account with $80,000 invested, well, if there's a 10% decline, you'd expect a loss of $8,000 on your securities. So if you want to protect half, you're going to look to protect $4,000. What amount of puts would you need to buy to have a $4,000 gain to hedge the $8,000 loss? And if you only have a $10,000 account with $8,000 invested, well, 10% decline would give you an $800 loss. You'd look to protect $400. Now your question, of course, now may be, well, what would you do? You've walked us through all these examples with different numbers, shown some of the risks of a ratio being higher than 1-to-1 and the risk of a ratio being lower than 1-to-1, and direct insurance on the position as well. So what would I do? If my holdings, whether it's right invested into SPY, which I know most of us aren't doing, or if it was vested in a group of stocks or covered call positions even that were heavy SPY allocation, but my portfolio is just around a 0.2, 0.3% gain or loss, and I'm worried about a decline. To tell you the truth, I would likely stick with the at the money that we showed in the first blog, the 250 strike, evaluate the equation to see how many contracts I need to buy if I'm expecting a 10% decrease. Or I might use the slightly in the money 251 that we just looked at in this presentation as well. I might still create a collar to help pay for the insurance, give myself a little bit of extra premium, maybe lower the cost basis on the total position. That's me personally. Now, if you're not sure what target you should use, that's where you can use the long option finder. If it's just a stock or if it's an ETF, put in your stock symbol, put in your target price for the decline, the rough date on when you expect that to decline, and it'll show you which put option would give you the best bang for the buck. Run the equation based on how much you want to protect of the potential decline, see how many contracts you need to buy, and then graph the position. If I have a gain in the underlying security, more than 3 or 4%, for example, I'm going to use that insurance tool. And I'm going to find the best put that locks in the most gain for my scenario and use a 1-to-1 ratio. I could also now sell a call against that to create a collar. That's under the assumption, of course, that I own the shares of SPY. Right? If I had a group of 10 stocks that were very heavy into SPY, and I decided that buying 18 contracts of the 250 put would give me the best hedge if SPY is trading right at 225, well, I can't go ahead and sell 18 calls on SPY now because I don't own SPY. I own 10 securities that represent the S&P 500 mostly. So I'd have 18 naked calls, which have infinite risk to the upside if SPY continues up and doesn't hit my decline. But that's why when we talk about the collar, it works if you own the security. The put insurance we're showing works for a portfolio hedge even if you don't own the security, but the positions in your portfolio are largely included in the S&P 500 index or ETF, or the NASDAQ index or QQQ. Of course, you can still manage other ways moving forward with the insurance tool also. Remember the 5 steps. First, decide what an effect an expected decline would have on your portfolio. Calculate how much of that decline you want to hedge. You're not sure which strike to start with? Use the long option finder to see which hedge would give you the best return if the targets are hit. As we saw, we're going to be probably close within that range of just a little bit out of the money or right at the money. Run that equation. Remember the put strike price minus where you think the stock's going to be to get your intrinsic value. Take the intrinsic value minus the cost basis of your put option, show you the gain per contract. Then take your monetary amount you want to hedge, divided by the gain, and that will show you how many contracts you should purchase. But again, graph the position. Remember, the combinations above a 1-to-1 ratio give you that great benefit of the straddle where you might actually profit if the decline is more than you expected, but you may end up having a higher risk. In our examples, if the stock was trading just at 235 and we'd bought 42 contracts, we're around $46,000. And the 230, of course, was about the same as well. But also keep in mind, Those under a 1-to-1 ratio, they're going to have potentially a higher loss if the decline is bigger than you originally expected. And that's the key to remember. So always graph the position. After you've run the equation, make sure in all scenarios it matches your risk tolerance and matches your target for what did you want to hedge on the position itself. So what should you do now? To get access to the long option finder, the insurance tool, plus the profit and loss charts we showed, head on over to PowerOp.com. You'll see a simple field there to just put in your name and your email address. That's all you need. You'll get to test our entire set of tools for 14 days. Also, there's a video that we did a few months ago called the hat trick for locking in gains. We showed, of course, how to lock in the gains using the insurance tool, but there's actually a way that I can get paid, generate premium against the position after I've locked in the gains, and still leave the upside open. We call it the hat trick because we lock in the gains, potentially, or control the risk at least, but then we generate premium to lower the cost, and we leave the upside open. So you can go to it here at this link, you can jot it down there, or simply just go to YouTube, search Power Options on YouTube, and then search hat trick for locking in gains as well. Of course, you want the direct link, you just send me an email any time to support@poweropt.com. And last but not least, keep your eye out for Part 3. In Part 3, we're going to get into the nitty-gritty stock or portfolio insurance. In the past, the first blog article, Part 1, and here in Part 2, we looked at the breakdowns of the different combinations to hopefully give you a better path of deciding what hedge you might want to use, what strikes you might want to look for to narrow down your range to insure your portfolio. But it was based on owning SPY directly. I doubt any of you are doing that, so why show it? To keep it simple and to get the basic pathways, guidelines, and equations down of what you would need to buy. Part 3, we're going to look at using a real portfolio, 10 to 20 stocks, or covered calls and spread positions. How would the puts that we're looking to protect our portfolio react in those scenarios, even though we're not protecting them 1-to-1? And then we want to take a look at what is the other forms of leveraged insurance. Buying calls on the VIX, which will increase in a market decline, with an exception. Part 1 of our series, we looked at maybe the benefits of using that 2 times bear or 3 times bear ETF to help with the hedge, but it wasn't cost effective. But what do we know about the bear 3 times S&P 500 ETF? It's going to go up if S&P declines. Maybe we can buy calls on the 3 times ETF. And of course, some of you want to pay for the hedge by itself. If I don't own SPY, I can buy puts on SPY to hedge against the portfolio and the market decline, but I can't sell calls against it. Can we do an elaborate ratio spread to still insure the position with SPY puts, but help pay for it, maybe with a ratio spread or some other combination? Of course, we're going to look at the pros and cons of each. So that's what's coming up in Part 3. I hope you enjoyed Part 2 of our presentation. Remember, send me an email at any time with any questions that you have to support@poweropt.com. Or, of course, you can call us during market hours as well. And if you haven't done so already, go to PowerOpt.com. All you need is name and email address. Sign up for that 14-day free trial. Take a look at the long option finder. And, of course, the insurance tool to help hedge your positions, either the stocks directly or to hedge your portfolio. And we'll talk more about those comparisons coming up in Part 3.